Rigby, one of the questions I get asked by a lot of my clients is, do I know a good accountant? And I always say, yes, I do. So can you tell me what makes a good accountant, please?
Dan, well, at Asset Accounting, we try to be very proactive, and I think that's probably one of the main things people are looking for in an accountant. Generally, accountants can be tainted with the brush that they're only looking after events after the fact.
Yes.
That is, clients come in after the end of the year to get their tax work done, and they would much prefer to have some advice prior to this event taking place. At Asset Accounting, we try to be very proactive.
Yes.
We've got a friendly staff, very approachable. I think they're the things that people like, having that relationship where you feel that not intimidated and just a good rapport with your accountant.
Again, I've referred a lot of my clients to yourself, being a good accountant. Can you give me a rundown, please, on what Asset Accounting specialises in?
We specialise in small business accounting. We obviously also do salary and wage earners tax returns, high wealth individuals. Our major focus is small business and self-managed superannuation funds. We've got a large client base who manage their own self-managed super funds, and this is an area we specialise in. As you were saying before, strategies involving transition to retirement pensions and the like is our bread and butter, I guess.
When we're talking about overall tax planning issues for individuals, what opportunities are available to them, please? So these are the salary and wage earners that I'm specifically looking at.
Well, generally speaking, tax opportunities available to salary and wage earners will also be available to businesses. It's more the fact that deductions available to salary and wages are limited, are more limited than those available to business, I guess. So when we're talking salary and wage individuals or taxpayers, they really are limited to amounts they've paid prior to 30 June. So their tax planning strategies for these sorts of people incorporate things like prepaying their professional subscriptions or that sort of thing. If they do have rental properties or other investments, they could consider prepaying interest on loans for these investments prior to 30 June, and they will also be tax deductible in that given year. With respect to rental properties, you can always bring forward repairs and maintenance expenses, things obviously that you know that you need to expend, but you can simply bring forward to the current financial year. It will certainly not make sense going out and repainting a house for the sake of it, if you know what I mean.
Thanks for that. What about clients that are in business? What other avenues are available to them, please?
Well, I guess businesses fall into two categories: the small businesses, which are entitled to the small business tax concessions, and large businesses. The small businesses are entitled to an array of deductions not available to the large businesses, and these basically stem around the government's encouragement or trying to make things simpler for small businesses. The first one comes off the top of my head, it relates to depreciation. Small businesses are eligible to write off any additions of plant and equipment that cost less than $1,000 in the year they were incurred. So if you were to buy a new computer monitor that cost $800, you would get able to write that off in the year that that's purchased. In addition to that, small business taxpayers are able to prepay certain expenses and also be entitled to claim those as tax deductions in the year that they prepaid those expenses.
As an example, say rent?
That's exactly right. Things like rent expenses, interest, as we've talked about previously, lease payments on vehicles and things like that, as long as the period that the payment relates to is not more than 12 months. So on 30 June, essentially you can prepay 12 months rent or 12 months lease payments, and you'll receive a tax deduction in the year that those prepayments are made.
Rigby, during this economic turndown, how do businesses account for their bad debts?
Okay, so some small business taxpayers will be accounting on the accrual basis, and some small business taxpayers will be counting on the cash basis.
Okay, could you just explain the difference between the two, please?
Cash basis accounting means that you only account for the income when it's actually received in your bank account. So if you invoice somebody on the 28th of June and you don't receive payment until the 28th of the next month, then that income would fall due in July next year as opposed to the current financial year. On the accrual basis, when you issue that invoice, that's when the amount is regarded as income by the Taxation Office.
Okay.
So in relation to bad debts, clients operating on an accrual basis need to write off any bad debts prior to 30th of June 2009. So if those debts aren't formally written off from the books, then the tax office won't allow you to claim a tax deduction in that year if they weren't written off formally. That is, if you're still chasing those debts on the basis that they may be collected, then really they're not bad debts and you aren't entitled to claim a tax deduction for them at that point in time.
Okay, so it's really having a look at your debtors and doing a chase up. And if people have said, look, we're not going to pay you, well then you can instigate either some sort of action against them or actually write those debts off.
That's exactly right.
Okay, lovely. I've also had a client who I've referred to about buying a car, and the car they were looking at was, say, around $80,000. Can you give us an example of how the tax breaks works for that for the purchase of that car, please?
The legislation framing this tax break is based on the depreciation provisions, and there's what's called a depreciation cost limit. So any vehicle that's worth more than $58,000 is considered a luxury car, and depreciation is restricted to that amount of $58,000. The same with the tax break. If you spent $80,000 on a motor vehicle, unfortunately your deduction will be restricted to that depreciation cost limit of $58,000.
So that $22,000 just it's on our books as part of the asset, but it just stays there. We can't depreciate that balance, or we don't get 50%.
That's exactly right. Similar to GST.
Yes.
And the depreciation cost limit, you can only claim back the GST up to the cost limit, and that's the same with this tax break. You can only claim the tax break up to the cost limit. Thanks,
Rigby. That was great. I hope you enjoyed the presentation. Rigby will be online on my forum on Monday night, June 29 at 6:30 p.m. Go to www.myonlinewealthcoach.com.au to the news and tabs events to register, and he'll be able to answer any queries that you have. My Online Wealth Coach is completely unique in the financial services field, where we do not sell products or receive commissions. We only educate and motivate clients. We're a financial advisory firm that specialises in business and personal coaching. For more information, go to www.myonlinewealthcoach.com.au.